and welcome to this week's Shoot the Moon podcast, broadcasting live and direct from Revenue Rocket World headquarters in Bloomington, Minnesota. With me today are my partners, Matt Lockhart and Ryan Barnett. Welcome, guys.
Thank you, Mike. Great to be here. Spring has sprung. I think we could, here in Minnesota at least, we could call it pollen season. I'm sure that's consistent around a bit. But we're fired up and ready to roll. What's going on, Ryan?
Yes, indeed. It's another good week in the world of IT services M&A. And in this podcast, we discuss all things M&A related for those tech services companies. If you have anything you want to talk about, let us know at info@revenuerocket.com. Today, hey, we're tackling something that sellers sometimes just don't ask soon enough. And it's a fairly easy question to ask, but I want to unpack it because it's sometimes hard to get the answer. And that question is, can a buyer actually pay? It's really easy to get excited by a big offer. And sometimes we see an offer come in that is higher than market. It has perhaps higher than industry standard multiples. But sometimes in order to get that deal done, the buyer may not have the cash or the backing to close. So if you don't have the backing or the close, none of that really matters. So we really want to talk through, how do we sniff out if a buyer's credibility is there, and how to avoid wasting time in a deal that may not be able to fund. So, Mike, I'd love for you to get us started. And when a buyer expresses interest, how do you qualify whether they actually have the capital to close a deal?
Yeah, great question, Ryan. I think what's really important is you have to understand who your buyer is, what they're planning to do. Are they really more of a financial buyer? You use these terms a lot, financial or strategic buyer. Are they a backed strategic, or what sometimes is called a sponsored strategic? What is the quality of that backing? And then are they one of a variety of different types of financial buyers? Some are called search funders, some are called independent sponsors. Some are called, that actually have committed capital, that are really a private equity fund with committed capital. What is their history of doing deals if they're a financial buyer and or strategic? You want to get some background on that. And as I've often said, deals have to line up strategically, culturally, and financially. Now, they have to line up all three ways. So it's important, I think, pretty early to understand, how, where the money's going to come from to do your deal. If you're going to contemplate signing an LOI or shortly after signing an LOI, reciprocal diligence on their ability to fund your deal is really important. Now, where that makes it tricky is, if they're a strategic buyer, oftentimes they're using debt funding. And if they're using debt funding, they need a signed LOI just to secure that with their bank, right? They need to get a commitment letter from their bank that they would have an intent to fund based on that letter of intent. And you should expect to see that pretty quickly for a strategic buyer. Or if they're backed by a sponsor, as it's called, a private equity firm, a private equity firm should be able to provide you what's called a comfort letter as well to let you know that provided everything checks out in diligence, they would be able to fund. And there's just a variety of proof points that you can get from a buyer that we'll unpack here in today's podcast.
Yeah, thanks for getting us started here, Mike. One of the next questions I got is around that exactly. But before we dig into that topic, I just want to go back to something, Mike, and just have you expand a bit around definitions. So a strategic company, this is someone who typically is going to have a balance sheet, or they might have a banking partner, or they might have a committed capital through a PE fund. That PE fund, just definitions wise, is more focused on committed capital that they have to spend. It's one way to look at that. Mike, help me out with that definition of PE, but also how does that differ specifically to an independent sponsor and in the mechanisms there? So if the PE fund is required to spend How does that differ from that independent sponsor?
Yeah, so oftentimes there's different levels of private equity funds. Almost all of them have what we call LPs, and we use that lingo in the industry, but considered a limited partner. A limited partner commits capital. They say, hey, if you find us a deal we like, we'll commit up to X millions of dollars of capital to be used and invested kind of around a particular thesis. So not atypical for a private equity fund to go out, secure limited partners, secure committed capital. But when they commit that capital, they typically commit it to for a period of time, meaning they don't give it to them forever. They say, hey, we're gonna give you 18 months to use this capital. If you don't use it, then we're gonna be out of the partnership. We're gonna take our money and we're gonna go elsewhere to find a different place to use it. Which means the clock is ticking for them to use and deploy that capital. And generally, that is part of what makes private equity firms that are funded by LPs very interested in putting that money to work. Now, private equity firms that do deals and ultimately make money can create their own fund, right? And the more established funds that are out there do commit their own capital also to the partnership. And so, when you see a company that's got $8 billion funds and they've gone through that, typically that private equity firm has done pretty well and has harvested and made some investment returns by assembling, you want to call it the syndicate of limited partners to go do deals that have been successful, that they've ultimately sold. And oftentimes they'll have their own fund within that private equity firm that also commits capital to do deals. And so, in cases of that scenario, they, depending on the size of the deal, may be able to just show you an account with the money in it, right? It certainly is a situation where they can deploy some of their own capital as part of a limited partnership associated with a particular fund. So hopefully that provides some clarity.
Yeah, it certainly does. I would say that if there's complexity in definitions here, making sure you understand the parties you're dealing with and their capacity in different ways certainly helps out.
Yeah,
Matt,
I'm going to jump back in though. I didn't talk about sort of independent sponsors. You did ask a question about how do we delineate an independent sponsor. An independent sponsor is someone who wants to find a deal, find an M&A deal, and then do fundraising, versus the definition of a private equity firm with committed capital is someone that's done the fundraising first and then begins their search for a deal. And there's certainly plenty of people that have started their fund as an independent sponsor. The challenge is, fundraising post-deal means that the likelihood of close, if you're that guy, right, you're the firm that's decided to sell into a platform that needs to get funded, is lower than it would be if you were going to do a deal with a strategic that has the capacity to do the deal, or the banking, have a banking relationship that can fund. Or someone who, has the limited partners lined up and, the time is ticking and they got to use those monies accordingly. And so, your certainty to close certainly goes down, because if they can't find the money, they can't find the money. Or oftentimes what it means is that it pushes out the time to close pretty dramatically. We've seen situations where timelines are pushed out 6, 9, 10 months, sometimes a year, while those independent sponsors are out there finding the capital to, deploy against their mandate and against the deals that they've signed up under LOI.
no, thank you for the additional qualification there, Mike. We at Revenue Rocket deal with, I think, all of these at some level, and some of it's dependent on size of the transaction. But even search funds are sometimes looking for 3 to 5 million EBITDA firms. So it's a fascinating environment when you get in there. And I think makes this topic even more incredibly important to walk through. Matt, if I was to transition back to something that Mike brought up, which is just simply, what are legitimate forms of proof? So, what are ways that you've seen buyers actually prove that they have the cash or capital to close? Now, what's fair to ask for, and when should they ask for that?
Yeah, great question, Ryan. I think that first and foremost, it's going back to understanding that buyer and sort of which category are they in. If it's a strategic buyer of size, right, and they have 10, 20, 30, 50, $100 million that's in cash that's on their balance sheet, right? The need for digging in on that, and or you are dealing with a well-established private equity firm that has multiple funds of hundreds of millions of dollars, right? Then that's a different classification than a strategic buyer who doesn't have a history of making acquisitions, right? And or they may be smaller. Um, or a strategic buyer or a financial buyer that has used a considerable amount of debt to make previous acquisitions, right? And so, first just re-emphasizing what is the classification and then what is the state. So in those classifications of people where there are, maybe more questions that are obvious about their ability to raise the funds or have the funds available within a reasonable time frame, post LOI within 90 days, because that's the baseline expectation that we set. I think that it's certainly appropriate to ask those questions earlier, and not in a bad way. It's not, not a negative. It is just it's just business, just the facts. I think that one of the other things that is important to ask is who is the ultimate who has ultimate sign-off authority on a deal. As Mike talked about, independent sponsors who are then, they have relationships. They've got multiple relationships of people who understand their thesis and their intentions. But who is it that is going to be signing off on the release of funds? And I think that that's one of those questions that you can ask early in the process to understand the path to funding, and then also get a sense of confidence and or lack thereof of the process and the ability to get there. If it is an independent sponsor, or a strategic that is backed, well, then that in either of those cases that that they are going to need to look to that LP for final sign off. And so being able to ask for, if not proof in the form of a letter, conversations with those limited partners, with those funding partners, to get a sense for their commitment and their process to sign off, is one of those early things that you can do in a process. As Mike mentioned, if a buyer is going to be looking for more traditional banking as a path, or in the case of it being an independent sponsor, they aren't going to be able to get full commitment letters until after an LOI is executed by both parties. But after that LOI is executed, then it is certainly an applicable question to be asking for commitment letters once there is a first review of financial diligence in place. Again, in the case of larger strategics and or PE backed funders, probably less appropriate to ask early. They've got a committed fund. The committed fund has made previous acquisitions in this space, and/or there is an existing platform in play. It's probably not as applicable to be asking earlier than it is, again, with those classifications of more questionable funding sources.
Sure, and it's from what I'm understanding for private equity buyers, you might have that commitment letter. So that's a formal letter backed by the fund stating they will fund the deal. You may have just proof of the dry powder, which could be a marketing report or fund report or an LP report. You could see deal announcements. You can get comfort if a fund just closed a new round of funding, or you might have even a debt financing commitment. Other ways, if you're on the other side, you could, for some of the strategic buyers, the balance sheet start to show things really clearly. Bank letters or escrows or even a board resolution might help out. So any of these just formal documents certainly help. Mike, Matt, I think we've even seen a case of where a seller is requesting a proof of funds in a smaller deal, and there's a picture of a personal bank account that had exceeded the enterprise value of the deal. And so we've seen some relatively creative ways to address this as well. Mike, if I turn a little bit and talk about some signals here, is there any, when you look at the deal structure of a deal, if a buyer leans heavily on an earnout or perhaps a long seller note, does that tell anything about their financial strength?
It may or may not, Ryan. I think it depends on the quality of the asset that's being sold, right? If there's been tumult in the up and down sort of revenue and profitability and it's lumpy, a buyer, regardless of their financial strength, might say, well, we really need to de-risk here in order to get to the enterprise value that we are hoping to get to get a deal done. And we need to see, we kind of need that seller to put the money where their mouth is, in the sense that they believe in their ability to get it done. And thus that, may portend a more variable or what we call gain share type arrangement in terms. I think what's important to note is oftentimes there's a correlation between certainty to close and the valuation on the deal. Certainly I think valuations need to kind of be in the market range, but if you're signing up for a deal that looks a little too good to be true, or it's above market sort of averages or norms for a deal like yours, you need to approach that one with a little bit of caution, because in a process where, let's say, you're going to market with a firm like Revenue Rocket to get and pick through a group of buyers for lack of what we would call an auction, better term, I'd call an auction process, or a structured process, maybe is a better term. You might see the highest offers have the lowest, likelihood of close because of either lack of financial strength, or they have to go find the money, or they're, maybe a situation where they just don't have their financial house in order to do the transaction yet. Doesn't mean they wouldn't, but, it's certainly a question. And then the additional complexity with that approach is that oftentimes if they've got to go to, they're sort of taking a merchant banking approach and going to find a combination of debt and equity lenders or participants. If the deal is above fair market for a firm like yours, keep in mind those lenders or those equity providers are going to look at that with a lot of scrutiny. And it makes it harder to fund the deal as well. So I think, be cautious for those deals that look like they're above market, that they have a reasonable likelihood to close, I think is really important. So to answer the question more directly, Ryan, I wouldn't say necessarily that a deal that's mostly contingent-based consideration points to a buyer that may have maybe not as much cash available. I just think it may be that, but it may also be part and parcel because of the quality, frankly, of the consistency of your growth and profit.
Yeah, a really comprehensive answer, Mike. And just the one tiny follow-up question, but in our industry, what does the expected cash at close look like? Can you give any guidance of what a quote unquote typical deal is, understanding that every deal is different?
Yeah, I mean, it's not atypical for us to see anywhere from 50 to 80% cash at close. I'd say 60 to 80 is more typical. And it really depends on the type of buyer and the structure of the additional consideration. And, are you rolling equity? Okay, are you becoming an investor in the new entity by, converting some of your equity into the new equity scenario? But that's not atypical. It also depends sort of on what additional upside is being brought to the table pursuant to any contingent or variable component. You might have an earnout that makes up 20 or 30% of the deal in addition to your quote unquote equity roll of 20 or 30%. So maybe it's only 40% cash. But in that scenario, you should have a high degree of certainty that, the 1 + 1 = 4 or 5, and that you're going to be able to wildly exceed that earnout target. That might be a great deal for you if you have that certainty and comfort. And so I think a lot of it just depends on the individual circumstance. But to answer the question more directly, 50, 80% is pretty typical.
Great. No, thank you. My question really comes, I think, and just trying to wrap this together. If you have someone that offers a 10% cash deal, yeah, you may want to look the other way or find other deals. And that's a lot of the role of the M&A advisor, which I'll get to later. Great. No, thank you, Mike. I appreciate the additional qualification there. Matt, I'd love to get into some perhaps suggestions of what happens or anything that you have seen where a deal, a buyer was not able to raise the funds in their initial funding source, and is there any storytellings or lessons learned when someone can't get to that funding source, and what other options they may have?
Yeah, I mean, I think that again, it's not personal, it's just business, but asking for as much transparency as possible, being pointed and asking for commitments on timelines and understanding, and are those timelines met or not? And say the timelines are not met, obviously, pressure is being applied by either, letting in an exclusive period run out and or asking for an out of the LOI and the exclusivity period has run out. And so, I think that obviously, to our earlier discussion, much better to get ahead of it earlier, right, to avoid these situations. But some of these situations are real and do happen, where even if diligence is applied, changes can be made. We saw that a little ways back, when the credit markets all of a sudden became in flux, and commitment letters were in place by limited partners, but their world changed, and so they had to relook at deals that they had committed to previously, and so there are some unforeseen circumstances. I think that making sure that in that structured process, for the people who didn't proceed towards LOI, keeping them in the loop, keeping them warm, so that there's a ready group of buyers to be able to go back to quickly, is certainly a first step. Keeping the sellers, focused on their day-to-day business. As we always say, the most important job of a seller is to continue to operate and run their business successfully throughout a process. And if they're able to stay focused on that, being able to, continue and or restart the process. Now, that doesn't mean that individual who wasn't able to come through in that first transaction process doesn't come back, with the money. They can always come back, but certainly, if they aren't able to transparently and openly be able to have the confidence and build the confidence with the seller and the advisors that they're going to be able to get it done in an extended time frame, then rightly so, changing the game and taking additional steps to have other parties in play.
Great topic here, both Mike and Matt. Uh, Mike, I'd love for you just to just bring this home with where's the role of an advisor here? So, how as we as M&A advisors, how can we help protect sellers here, and what's the role of an advisor?
Yeah, Ryan, one of the key roles an advisor plays is what I would say qualifying the buyer, right? Qualifying the offer in a situation where we're bringing you to market, qualifying the buyer's financial readiness to do the deal, qualifying the buyer's alignment around strategy, culture, and finance fit, and being able to help. What we often use the term, because we're up here in hockey country, I guess, in Minnesota, sort of stick handle the whole process, because there's a lot of moving parts, right? And it's easy to get distracted by, due diligence and financial review and, of the seller when there's other things that need to be done at the same time, including validating the quality and capacity of a buyer, which certainly an advisor should be able to do early and often, and be able to be transparent with their client about that quality and capacity. And be able to say, look, if you're going to take the risk on a higher than market multiple or offer, or one that looks really good, oftentimes that comes with additional risk to the certainty to close. And you have to decide if that risk to certainty to close makes sense or not. And or maybe it's more it's a better program to maybe be a little more have a little more competitive offer, or one that has less risk all around in its amount as well as its certainty to close. But in all of those cases, the advisor should be advising you about, how do you, one, keep the process moving in a timely manner to close as quickly as possible, but also to be able to qualify all aspects of the deal and to keep you fully informed so you can make the right decisions on, when it might be time to move forward or when it might be time to pull back.
Thanks, guys. This is a great topic here today. I'd love to wrap it up. I think a big takeaway that I heard was that it's not enough for a buyer just to have a great multiple, and that you really have to look at the structure of the deal. You have to look at the source of the capital and the track record of its success. So we should look for proof, and you should feel empowered to ask for proof relatively early. So again, thank you both for tackling a really important subject here today. Mike, I'll turn it over to you for any wrap up.
Sounds good, Ryan. With that, let's tie a ribbon on it for this week's Shoot the Moon podcast. I would encourage you to tune in next week when we'll unpack further ideas and concepts around IT services, M&A, and growth strategy. And certainly look forward to hearing from you guys about your suggestions about the podcast, or questions or topics you'd like us to cover. You can drop us a note at info@revenuerocket.com. And as well, just check us out if you haven't been on our website There's quite a bit of useful content there for IT services companies contemplating their next move of growth, acquisition, or sale. So take care. Make it a great week.